Now, I'm joined by Tom Holland, Director of Cube Capital, where he manages the Cubridge Fund that invests in non-performing loans and other distressed assets in China as well as credits Asia-wide. Tom, very good day. Thanks for joining us today. OK, one of the key parts of your fund is non-performing loans in China. This is a China which at the moment appears to be, if anything, accelerating its growth. Stock market's booming, property prices are on the way up. Surely it could grow its way out of any loan problem.
Sure. Well, first of all, it's very simple supply and demand. You have $300 billion US of legacy loans in the system, stuck in the asset management companies, state-owned asset management companies, or they carve out from the Agricultural Bank of China, which is sitting in another government agency. This year, we're seeing about 4.6 trillion of loan growth just in the first few months of the year. We're looking at about 9 trillion of loan growth for the year in RMB. If we apply 2% non-performing loan rate to that, to the new loan growth, you know, we're looking at having about over 400 billion of bad loans in the system.
Right.
So despite this growth, we're still seeing restructuring of large parts of the economy. Specifically, if you look at light industry in Guangdong province, we've seen a number of these manufacturing exporters going out of business. This is all going to hit the NPL numbers over the coming months.
Let me just break it down then. Basically, you're saying that even if the ratio of non-performing loans doesn't increase, there's still going to be a lot more of them simply because the loans have grown.
That's right. I mean, the supply side is one side of the equation, and the demand side is the other.
And in terms of the non-performing loan ratio, you think that's likely to go up anyway. Over what period of time?
We'd be looking at a period of, say, 12 to 36 months. Obviously, the government stimulus can really have a big impact either way.
How high might it go, do you think?
You know, I think we're bullish on China as a whole. It's GDP growth and the growth story. So, you know, right now we're talking 2%. We wouldn't expect a significant growth on that percentage number, but we see a significant growth on the absolute loan book.
Okay.
So.
I mean, that's quite a long way off in terms of making money. Are you making money on non-performing loans at the moment in your fund?
Yeah, I mean, as I pointed out before, there's already about 300 billion in the system, and there's certainly not that kind of demand for this asset class. And especially what we've seen over the past few months, we've seen a lot of that demand being taken out. A lot of the investment banks that were playing in the space no longer have the capacity or balance sheet to be participating in these types of illiquid investments.
What kind of returns are you getting?
Right now, it's a mid-teens return. We would expect that at some point, these asset management companies, the state-owned asset management companies, will be forced to wholesale a bit more. Then we would see that move more closer to 20, low 20s.
Okay, that's not a bad return. What kind of investors are you attracting to this fund? I mean, your average retail investor coming in, or this is institutions, or what? This
is very much an institutional investor product, and it tends to be viewed as a diversifier. The returns we've produced so far since December 2006 have been 13% annualized, so pretty steady throughout this rough patch in the markets. And as a result, I think most institutional investors view this as a diversifier.
Are there many people, I mean, if you can generate that kind of return, even when the economy is growing and there's relatively low rate of default at the moment, you would suggest a lot of players would come in and start offering similar funds. Is there a great deal of competition out there?
Well, there are very high barriers to entry. It's not your typical strategy where you can plunk a Bloomberg on your desk and go to town. It happens to be, the key to the whole thing is having a good servicing partner onshore. And to build and structure that relationship the right way is a 1 to 3 year process. So it's a very high barrier to entry. And even going through that process, you still may not be sure you have the right partner.
You have a partner, Hangzhou, is that private MPL servicing company?
It's a Hangzhou-based servicing company. What we liked about them is they had a strong track record investing their own money before we met and had a meeting of the minds. We tested the relationship a bit, and then we formed an exclusive JV partnership. The key to this whole strategy, we think, and where people have gotten it wrong in the past, is the partner co-invests on every single portfolio with us, meaning the interests are completely aligned.
Okay, so yeah, they take the risk if they don't just offload it onto their Guaylo partner over the border. Simple as that. Okay, fair enough. So that's looking quite good for you at the moment. That is the non-performing loan side. Let's take a look at another part of your business. This is asset-backed loans you're making. Basically, people who want to you're basically lending to people who want to make decent portfolio investments, but they don't have the cash to do it.
Yeah, that's right. I mean, basically, because of our onshore partnership, we have this platform that's able to lend in RMB onshore, which differentiates us because we can take a first lien on a hard asset in China, which is something very special, and as a lot of funds are finding out now, it's very important. The types of lending we've been doing is primarily to property developers, because as you know, at the end of 2007, the government cut off credit to that sector to curb speculation. As a result, there was a huge demand for finance, and we were able to be running finance or asset-backed loans at about 20% or over 20% with loan-to-value ratios below 50%.
Okay.
So pretty secure lending.
That's extraordinarily good as well. I mean, what's the problem here? State-owned enterprises, we saw from figures coming out today, state-owned enterprises are doing the bulk of the new investment in China over the first 5 months of this year. So the private companies are being squeezed out.
Yeah, I mean, right now we're seeing tremendous loan growth. So intuitively you would say, well, how can you can continue to find these opportunities? And I would say definitely the opportunity set has changed from last year. We would definitely view that as a cyclical opportunity. Despite that fact, most of the banks, they want to lend to state-owned enterprises. They view that there's no credit risk in the situation. It's easy to go to their boss, get the approval to make that loan. As a result, some of the smaller, medium-sized developers still struggling to get financing, and there's still a tremendous appetite for finance.
Is there any risk to you from people investing into a property market bubble which may be occurring in parts of China?
Yeah, I mean, we look at that very closely, and we look at that from managing the downside of the collateral. So we're not here to make calls on which property market's going to be good for investors within China. So China's a very big market. You have inventory and price-to-income levels that vary quite a bit across the board. So there are certain areas we wouldn't touch collateral in. Right now, for example, Xi'an has over 20 months of inventory on the market. That's, to us, obviously, that means price problems down the road or collateral value problems down the road. Interestingly enough, we're seeing some pretty interesting low inventory numbers in places like Guangzhou, which for a while were a no-go zone. So we're starting to see parts of Guangdong come back and become interesting again.
Okay.